Thanks, Tom. This is Jeff Tjornehoj. Thanks, everyone, for joining me on this quarter's fixed income review. We'll kick things off with a view of what happened in the fixed income mutual fund space as far as performance goes. These are all total returns through September 17th. General U.S. Treasury funds, these are the long duration Treasury products. They had the best performance out there for this quarter so far. Again, with a few weeks left, we'll see if this stands up. For the most part, Treasuries were definitely in the catbird's seat. They were the best performer as a group, with the exception of inflation-protected bond funds. Other areas, corporate and mortgages certainly did not fare quite as well. We'll cover those in more detail. And as you can see, obviously the worst performing group is in the world income space, with emerging market local currency by far the greatest losses so far this quarter. When it comes to interest rates in the U.S., there's a lot of hand-wringing over what Janet Yellen and crew were going to do. I'd say that the United States, when we're looking at interest rates right now, obviously with the United States is that tiny little red block right there. The Fed funds rate is very, very low. This compares to central banks in other countries. Switzerland is negative, so of course it's difficult to keep your money in Swiss francs. On the other hand, you can find better rates in, say, Canada or even Russia and Brazil, yet you're having a difficult time with inflation over there running in double-digit figures. So I'd say the United States is going to continue to be the most attractive place for cash holdings. We'll get into more detail in a few minutes. Let's look at the risk in mutual and fixed income mutual funds in the quarter so far versus the first half of the year. And in the first half of the year, it's the red bars here. You definitely lost money taking risk in the first half of the year. By taking a moderate amount of risk, there was some interesting returns to be found, and certainly the more conservative stuff was paying well. This quarter so far, similar story, although taking middle of the road risk was definitely out of favor if you're in the fourth, fifth highest decile for risk. Again, you lost money this quarter. You made money in the first half of the year. So people are, if you look at this as kind of like a phase shift, risk is coming in, and people are not willing to take so much of that in the fixed income space. They still want to get paid, but we're willing to take 50 basis points a quarter because we don't want to face too much risk. And the most conservative stuff is the most overbid right now. It's not returning anything. There's just no yield left on some of this very conservative paper out there. Certainly will depend on what kind of paper, whether it's U.S. or ex-U.S. sovereign. But for the most part, staying at home is where the best returns are found right now. So this is the Barclays aggregate month by month so far this year. We started off strong in January, and then things started to get pretty shaky. We've had a tough time eking out returns. We're at about 1 percentage point in total return on the Barclays aggregate right now. Certainly, there's a little bit to be played out in September, and the fourth quarter should be interesting. I do expect us to have a positive return on the aggregate for the full year. At the beginning of the year, I thought 2% was an adequate return. We got off to a fast start before having to give back a lot of that. I still think we could end up around 2% for the year. So time will tell where we're going to end up. At this point, we've had some disappointing returns given the volatility out there. I would characterize it that way. The yield curve barely changed, though, over the course of the quarter. Here we're comparing September's thick red line with the lighter gold one in June, and I think that's indicative of where people are viewing risk right now, especially at the long term. There's not much threat of inflation ruining bond fund values. At the short end, it pays almost nothing, of course, and that hasn't changed. So overall, really nothing new this quarter on the yield curve. However, when we're looking at individual tenors, there's been some volatility. We did see bids coming into the market through August. And then as investors sense that the Fed may be getting close to making a decision in September, along with some other issues, we kind of gave up some of that. So overall, if we're looking at the longer term paper, it was down for the quarter and in terms of yield, and that was good for long-term Treasury products out there. Long duration Treasury did especially well. Once we get farther down into like the 2-year area, things were not quite that easy. You really had to fight to make any returns and be very particular about where you were putting your money to work. So in a nutshell, Treasuries were in play over the quarter, but really the long end benefited far more than the short end. So let's take a look at a couple of corporate debt areas, specifically the A-rated, BBB, and high yield. Very different outcomes this quarter, with A making more money than B, who had a slight loss, about 4 basis points or so. High yield funds with about 200 basis points in loss were playing cleanup this quarter, which is a bit different than what a lot of people expected. And we're looking at the corporate spreads over the quarter. Things widened out considerably once we got to the end of July. They'd been rather benign for high yield for quite a while over the summer, but things started to get carried away. Again, as concerns about a slowdown in China and oil prices especially were impacting the high yield market. While defaults have creeped up a little bit in the corporate space, I think Fitch reported that in August we saw corporate defaults climb from 2.5% to 2.8%. Seems like a big jump. However, a lot of that is concentrated in mining and metal, as well as energy sectors, and those are the ones that are having the most difficult time. The rest of the universe looks pretty benign for default data. So again, being careful where you're choosing your high yield paper made a significant impact on total returns for these high yield products. We did see spreads on BBB widen just a little bit. Still looks fairly benign to me, but we're looking at about 20-25 basis points over the quarter. AAA in this case was very flat. I don't think anyone's worried about defaults right now. It's not showing up here on the corporate side in the higher quality issues, of course. This is where things started to get kind of hairy, though, for corporate paper is on the total return, because we had so much going on in the various treasury in the treasury market that total returns for corporate debt were kind of all over the place for the quarter. A coming out on top, as we saw before. These are the total return indexes, not the funds themselves. So this is what the fund managers had to contend with. You can see it high yield raced ahead through the end of July and then came down significantly, again, as people, I think, overreacted to defaults in certain pockets of the high yield market. Next group to look at is emerging markets. Here again, I think Tom touched on the strength of the U.S. dollar. We've got runaway inflation in Brazil, Russia. So things are not looking up in a lot of areas in the emerging market realm. Having a difficult time with China slowing down, and really anything commodity related, certainly emerging markets are. They've had a difficult time this quarter. I expect next quarter to come in with similar, certainly same direction, if not similar numbers. And so I think the magnitude will remain challenging as far as eking out returns. You're going to lose money next quarter on emerging markets is my bet. So here we have emerging market hard currency and local currency funds against a common benchmark, the EMBI Plus from JP Morgan. The benchmark itself managed to earn some positive returns through last Thursday, while we saw funds benchmarking it having a much more difficult time. Of course, they don't have, I mean, they have expenses and they've got other things to contend with that the index doesn't have here. But the local currency market is just falling farther and farther as the weeks go by without much of an end in sight. Finally, the last group that I'm going to talk about is the high yield market. They had a pretty good run this quarter. Again, when treasuries do well, it's common for for munis to follow in suit. In terms of flows, it's been a difficult time for munis to get a whole lot of retail interest this quarter, which plays a lot into the returns in this space. But somehow they managed to beat expectations and kind of perk up a little bit, anywhere from about 50 to 100 basis points in total return for the quarter in this group. However, when we look at the story this quarter, it was all about Puerto Rico. You can see at the short end how things have changed drastically compared to the end of 2014 on that Puerto Rico yield curve. I think over the long haul, investors don't expect to see anything significant out of Puerto Rico. Again, it's a triple C minus risk right now. Could be potentially worse than that, but right now that's where we've been for a couple of quarters. So I think the default risk in Puerto Rico is limited. I think when we're looking out, over a couple of years, short term, I think there's a lot of headline risk that investors have faced. One of the governor of Puerto Rico came out over the summer and said, "Hey, we can't pay this debt. It's not that we don't want to; it's that we can't. The math doesn't work." I think that's a lot of political grandstanding. I think he just does not like paying bills, but that's not going to be his choice. Other areas with a difficult time, Illinois, I wanted to point out the curve on Illinois debt has been raised over the last several months. It's not quite where Puerto Rico is long term, but it's interesting that short-term prospects for Illinois are fairly benign. Long term, that's where people start to really worry about what's going on with the overwhelming pension obligations that we don't seem to have a solution for. So that's another one to keep your eye on. It's not Puerto Rico, but it's still a very significant risk in the long term. Overall, if we're looking at AAA states, very little change overall. Slight raise in the long-term yield curve going from 2022 out. But overall, not much of a change in the course of the quarter. So I think here's my wrap-up, my concerns. China certainly plays into everyone's mind front and center. It's changing. The economy is changing. Its ability to push economic growth through more quantitative easing is running into a brick wall, and people don't know what comes after that. And I think that's where the concern is. I think people are paying too much attention to what the Fed is doing. We're talking about the Fed funds rate here. It's an overnight lending rate. It's really, I don't think, as meaningful to the overall economy as the media pundits portray it, but I don't think they have much else to work with. I think there's going to be more easing in Europe and Japan. That's going to keep the U.S. Treasury paper attractive. We saw some interesting news this morning from the Wall Street Journal that one-month Treasuries had one of their biggest auctions yet. Some of it was dipping in negative territory, which is kind of a tough place to put your money away. So I think that kind of attention on treasuries is going to continue throughout the rest of this quarter and into fourth quarter. Again, low for longer. That's the mantra. I'm starting to believe, like Jeff Gundlach, that the Fed is probably not going to raise rates in December, maybe in 2016, but I'm starting to think that we could push it out into 2016 as well. I think spread products are still attractive. Certainly, if we're looking at inflation products on the Treasury side, tips are really going to have a tough time. So that will wrap it up for me. I'd like to turn it over to Min Sohn, the portfolio manager of the Meridian Equity Income Fund, who comes to us from Arrow Point Partners. Thanks for joining us, Min.